Did you know that some Bitcoin miners pay virtually zero taxes despite generating 6 or even 7 figures in Bitcoin? Just like the most successful builders of wealth in the world, it's not because they're breaking the law, it's because they understand something that most miners don't. You see, Bitcoin mining isn't just a way to earn crypto, it's one of the most tax-advantaged businesses that you can run today. I recently worked with a client named Dean who was about to pay taxes on over $400,000 of income, which was $350,000 more than he needed to on his mining operation. That is, until we restructured his approach. By the time we finished, his taxable income dropped to under $50,000 completely legally. And in this video, I'm going to show you exactly how Bitcoin mining can be a tax gold mine when structured properly as a business. Whether you're mining from your apartment with a single rig or running a warehouse full of ASICs, these strategies could save you thousands or even hundreds of thousands of dollars. Let's dive into the world of Bitcoin mining taxes, where understanding the rules doesn't just keep you compliant, it can dramatically boost your bottom line. Quick but important disclaimer, I am not a tax professional. This video is for educational purposes only. Always consult with a qualified tax advisor before implementing any tax strategies. Your situation may differ. Now, let's dive into how mining taxes actually work. Let's start with the basics of how mining is taxed, because this framework is the foundation for all advantages that I'll show you later. When you mine Bitcoin, the IRS views this activity in one of two ways, either as a hobby or as a business. This distinction is absolutely crucial for your tax situation. If your mining is classified as a hobby, you'll still owe taxes on every coin that you mine at its fair market value when received. But here's the problem. Since the 2018 tax law changes, hobby expenses are essentially non-deductible for most people. However, when your mining qualifies as a business, everything changes. You still report the fair market value of mined coins as income, but now you can deduct all of your legitimate business expenses: electricity, equipment, repairs, space rental, internet, cooling costs, and more. The IRS looks at several factors to determine if you're a business. Do you maintain complete records? Are you mining with the intention of making a profit? Do you put significant time and effort into it? Have you made changes to improve profitability? Most dedicated miners easily qualify as businesses once they understand these requirements, and that's when the real tax advantages begin to emerge. Here's where mining as a business really shines. Let me walk you through the key tax advantages that Bitcoin miners can leverage. The first major advantage is business expense deductions. Nearly everything that you spend on mining becomes deductible, substantially reducing your taxable income. Let me show you how powerful this is with a real example. One of my clients mines Bitcoin as a business and generated about $1.2 million worth of Bitcoin last year. Without any deductions, that's $1.2 million of taxable income. But as a mining business, he deducted $570,000 in electricity costs, $350,000 in equipment depreciation, $120,000 for facility rental, $50,000 for networking and cooling systems, and $60,000 for repairs and maintenance. That's $1.15 million in legitimate deductions, reducing his taxable mining income to just $50,000 in a business where he cleared $440,000 in Bitcoin. The tax savings were enormous, which means he gets to hold on to more coins. But the advantages don't stop there. When you later sell those mined coins after holding them for over a year, you qualify for long-term capital gains rates. These rates range from 0 up to 20% depending on your income, which is much lower than the ordinary income tax rates up to 37%. This creates a powerful two-step tax strategy. You deduct most of your expenses against ordinary income when mining, and then you pay lower capital gains rates when eventually selling. Or, if you're like most hardcore Bitcoiners, you can choose to never sell, and thus never be taxed on the gain, and instead borrow against your holdings to get cash without any tax penalty. It's completely legal, and it's one of the most efficient tax structures that's available to small business owners today. Now, let's explore some more advanced strategies that can take your mining tax situation to the next level. Section 179 expensing is a game changer for professional miners. Instead of depreciating your mining equipment over 5 years, this provision lets you deduct the full cost in year 1 up to $1.25 million in 2025. If mining is your primary business activity. This means that you can write off those expensive ASIC miners immediately. For example, if you invest $200,000 in mining equipment, you could potentially deduct the entire amount in the first year rather than spreading it out over 5 years. This matching of expenses with income is especially valuable in the volatile world of cryptocurrency. Even better, if you're able to get financing on your equipment, you may be able to offset more money on your tax bill than you actually spend out of pocket to get it. This is an advanced strategy that high net worth investors use frequently, but is not commonly understood. Business structure also matters tremendously. Many miners start as sole proprietors, but eventually benefit from forming an S-corporation. Why? With an S-Corp, you can pay yourself a reasonable salary and take the rest as distributions that aren't subject to self-employment tax. This can save you approximately 15.3% on a huge portion of your income. Entity type and timing is also crucial. If Bitcoin's price is down when you mine it, but you expect it to rise, an entity that allows for pass-through taxation could be advantageous. This lets you claim the business deductions immediately while potentially paying lower capital gains taxes later. For miners with significant operations, you should also consider exploring opportunity zone investments. If you establish mining operations in designated opportunity zones, you can defer and potentially reduce your capital gains taxes. And I've seen miners relocate operations to these zones specifically for the tax benefits. One fascinating area where Bitcoin mining stands out is at the intersection of energy use and tax incentives. Contrary to popular belief, Bitcoin mining can actually support environmental goals and unlock additional tax benefits in the process. Miners using renewable energy sources like solar, wind, or hydropower may qualify for various energy tax credits. The federal investment tax credit can offset up to 30% of the cost of installing renewable energy systems to power your mining operation. There are miners in Texas who partnered with the wind farm to utilize excess capacity during off-peak hours. Not only did they secure discounted electricity, but they qualified for substantial energy credits, creating another layer of tax advantages. Natural gas flaring provides another opportunity. In oil fields, as well as landfills, excess natural gas is often burned off or flared as waste, or it's even released into the atmosphere completely untouched. Miners who capture this otherwise wasted energy to power their operations can potentially qualify for carbon capture credits while securing extremely low-cost energy. Heat recycling is emerging as another innovative area. Miners who capture and repurpose the heat generated by their operations, for example, to heat buildings or for agricultural purposes like greenhouse warming, may qualify for additional efficiency-related tax incentives. The key here is understanding that mining's energy-intensive nature, when it's approached thoughtfully, can align with both environmental goals and tax incentives, creating additional avenues for tax savings that most miners overlook. While the tax advantages of mining are substantial, there are several critical pitfalls that you need to avoid. The biggest mistake that I see miners make is poor record keeping. The IRS requires you to record the fair market value of each Bitcoin received through mining at the time that it was received. Without this documentation, you could face significant issues during an audit. You can use your mining pool reports, blockchain explorers, and cryptocurrency tax software to maintain accurate records. Screenshot or download price data on mining days as additional backup. And remember, the burden of proof is on you as the taxpayer. Another common mistake is commingling personal and business funds. Maintain separate wallets and accounts for your mining business. Not only does this strengthen your case that you're running a legitimate business, but it also makes accounting dramatically easier. Misclassifying mining status is another pitfall. Some miners incorrectly treat their activities as investments rather than business income. You see, mining generates ordinary income when the coins are received. Treating it otherwise can trigger IRS scrutiny. Finally, be wary of the hobby loss rules. If your mining operation shows losses for several years, the IRS may reclassify it as a hobby, disallowing your deductions. To prevent this, document your profit motive through business plans, operational improvements, and eventually profitability. Looking toward the future, several trends could impact your Bitcoin mining tax strategy. First, regulatory clarity is improving. The IRS is providing more guidance specifically addressing cryptocurrency activities, including mining. While the fundamental tax principles remain constant, expect more detailed guidelines in the coming years. Second, entity structures continue to evolve. We're seeing increasing interest in mining cooperatives and partnerships that allow for more flexible tax treatment. These structures can distribute tax benefits more efficiently among their participants. And third, jurisdictional considerations are becoming more important. States like Texas and Wyoming are creating mining-friendly policies, including energy incentives and favorable tax treatment, strategic relocation could become part of your long-term tax planning. And as one client recently told me after implementing these strategies, I knew mining would be profitable from a Bitcoin accumulation perspective, but I never realized the tax benefits would actually double my effective return and operate like a turnkey business. The tax advantages of Bitcoin mining as a business represent one of the most overlooked aspects of the cryptocurrency space broadly. When structured properly, mining offers a powerful combination of business deductions, favorable capital gains treatment, and specialized tax incentives that few other business models can match. The key is approaching mining deliberately with proper documentation, clear business practices, and strategic planning. The difference between treating mining as a casual hobby versus a structured business can literally mean tens or even hundreds of thousands of dollars in tax savings. And working with the right mining partner from the start can put these action items on easy street. Remember Dean from the beginning of the video? His $350,000 tax savings didn't happen by accident. It came from understanding and applying these simple principles systematically. If you're serious about mining, consider consulting with a tax professional who understands the cryptocurrency markets. The investment in proper tax planning almost always pays for itself many times over. Thanks for watching. If you found this helpful, hit like and subscribe for more Bitcoin content, and drop your questions in the comments below, and I'll do my best to address them in a future video.